Imagine investing in tech stocks and missing out on AI, or buying into energy but choosing the wrong company. What if there was a safer way? Welcome to sector investing, where you bet on an entire industry rather than a single company. Instead of trying to pick a single winner, you spread your risk across the entire sector. Many investors believe they can find the next big stock. But the truth is, even professional fund managers struggle to consistently outperform the market. Picking the right company at the right time is extremely difficult. One bad earnings report, a leadership change, or a sudden regulatory shift can cause an individual stock to plummet. Think about it this way. If you had invested in electric vehicles years ago and only picked one company, say Tesla, you would have made significant gains. Although, throughout its history, Tesla went through periods of significant struggles. But what if you had picked another struggling EV company instead? You might have lost money. However, if you had invested in the broader sector, such as through an ETF focused on electric vehicles or clean energy, you would have gained exposure to multiple winners instead of taking a gamble on just one. Companies within a sector tend to move together. So even if one company stumbles, sector investing ensures you still capture the growth of the industry. Let's look at an example. The rise of artificial intelligence has been one of the biggest market trends in recent years. NVIDIA has skyrocketed due to its dominance in AI chips, but it's not the only company benefiting from AI. Microsoft, Google, AMD, and other tech giants are also seeing growth because AI is transforming how businesses operate. Instead of betting everything on NVIDIA, investors who bought into the broader AI sector through ETFs have seen solid gains across multiple companies. This approach works across all industries. Consider healthcare. Investing in a single pharmaceutical company can be risky. Drug trials can fail, patents expire, and regulatory changes can impact revenue. But if you invest in the healthcare sector as a whole, you get exposure to multiple strong companies like United Health, Pfizer, and Johnson & Johnson, reducing your risk while still benefiting from medical advancements. The easiest way to invest in sectors is through ETFs or exchange-traded funds. ETFs allow you to instantly get exposure to an entire sector without spending hours researching individual stocks. Instead of buying multiple stocks one by one, you can invest in a single ETF that tracks an entire industry. Industries tend to cycle over time, and when one sector reaches its peak, others might be at the bottom. This creates opportunities for investors to rotate out of sectors that have become expensive and into those that are undervalued. For example, when the technology sector reaches an all-time high, sectors like consumer staples or utilities, which may have lagged behind, could be primed for a comeback. By staying aware of these cycles, investors can strategically exit overheated sectors and move into those with higher growth potential. For long-term success, sector investing could be your smartest move and is arguably the best strategy for beginner investors. Whether you're bullish on technology, healthcare, finance, real estate, or any other industry, sector ETFs offer a simple, effective way to gain exposure and minimize risk. Want to learn more? Follow for smart investing insights.